Hey guys, welcome to Golden Cross Life. My name is Chue. Don't forget to hit that like and subscribe for more content. Now, have you heard people say buy terms and invest the difference? Does it really work? It could work, but it's not the answer to everything. Now, there's no perfect product out there that can solve all the problems, but it's about options and awareness. So let's dive in. I can guarantee you 100% that we are all gonna die at some point. At any time, you and I can perish at a snap of a finger. If you buy term life, there's nothing wrong with that. But it's kind of like a casino. You're the player and they're the dealer. They win most of the time. Now, if you live past your term life, you lose all of your money and you lose the death benefit. So let's say later down the road, you want to get another term life. Know that it's going to be more expensive because you're older now. So why not make a guaranteed bet on death? Because we already guarantee that we're going to die at some point. And the way to bet against it is through permanent life insurance. It's guaranteed to cover you for your whole life. Yes, it's expensive. It's more than term, but that's because it's more valuable. The more value it has, the more expensive it is. Starbucks is a very good example. Why are people willing to pay $5 to $6 for a cup of coffee when they can cheaply make it at home? Well, it's because the quality of the coffee and the experience that they're getting. So they're willing to pay money for that. So let me ask you something. Would you put $10,000 into the machine if it was going to give you $100,000 guarantee? Would you put $100,000 into the machine if it was going to give you $1 million guarantee? Most people won't even hesitate. Now, this is not your typical traditional whole life that you think I'm talking about. This is the policies that the banks, corporations, and wealthy individuals has been using for decades. It gets even better. You can bounce payment up and down or be out of pocket at a certain period and still reap all the reward. So I'm asking you to take off your buy term and invest a different lens out for a moment and put on a different lens to see if this method works for you. Fair enough? Great. Let's dive into the numbers. So let's start off with the term life. So this person got a 10-year term. So on the first year, he's paying $605 for a $1 million death benefit. It's going to last him all the way to year 10. But what do you notice on year 11? His premium jumps up dramatically. Now, at this point, people usually just drop the policy, but they lose their money and they lose the death benefit. But let's say this person is stubborn and wants to keep on paying for it. You notice that the premium keeps on increasing and the death benefit still at 1 million. So on year 45, he's already put in more than what he's going to get back on the death benefit. So for transparency, this is where I got the number. I ran an illustration for a 10-year term. You can always hop back and forth to compare the numbers. Now, these are the policies that the wealthy has. You notice that on year 1, this person's putting $50,000 in and they see immediate cash value of $42K. Now, they have access to that right away. They can take a loan against it and purchase a rental property or whatever they want with it. That's another rabbit hole. I'll create another video for it, but it gets deeper than that. Now, their death benefit is almost $1 million. What do you notice on year 5? Year 5, this person broke even because they put $250 in and they got pretty much almost $252 back. So they got a little bit more than what they put in. So that's break even. They got all their money back. So any years after that, they're going to get more than what they put in. And the death benefit, you see it increasing, right? So now this person stopped paying out of pocket on year 8. What do you notice? First, he's not paying any penny in. No dollars, no money. He's out of pocket. But you notice the death benefit drops. It's called RPU, reduce paid up. And that has bought him a reduced death benefit. But here's what's happening. So the moment we cut it off, all expenses are out the door. The interest and dividend kicks back into the cash value. So here's what you'll also notice. The cash value never drops. It keeps on increasing. What do you notice on the death benefit? It also keeps on increasing. Look at them too. They keep on increasing down the roads and you're still out of pocket. The death benefit has a direct relationship to the cash value. Now, during this whole time, you can get access to it and still use it while you're alive. And you're out of pocket on year 8 all the way down. And if you were to pass away on age 65, you got $1 million, your cash value is $1 million, your death benefit is 1.6. So this death benefit is paid out to your beneficiary income tax free. So for transparency, this is where I got my number. Now you can't compare them apple to apple because they operate differently. I put them side by side just for fun so you can see option and awareness. The left is the term, the right is the policy the wealthy has. Obviously, this term covers you for 10 years. Any years after that, the premium jumps up dramatically. Usually at this point, people just drop it. So it results to all the money gone and no death benefit. So let's say this person is stubborn and wants to keep on paying for it. So we scroll down, this term policy only covers till age 90. So on age 90, you put in 3.5 million into the policy for a death benefit of $1 million. Now, no one in the right mind will do this because it doesn't make sense. Now, the one on the right, again, remember this person is out of pocket on year 8. This policy is covering him till age 121. So going back to age 90, he has only put in $350K and has a cash value of $3.1 million and has a death benefit of $3.4 million. So the question comes down to, do I want to buy the term and invest the difference and taking the chance of losing that policy at a certain period? Or do I want to put money on the right and have access to my cash value while I'm still alive to use it to invest into other things while still having a death benefit and being out of pocket on year 8 and being covered all the way till age 121? Okay, you can take off your lenses now. Now, there are more creative ways to do this, but you're more educated and you have option. And after all of this information, you still want to buy term and invest the difference? By all means, have at it. Till next time.